Welcome everyone to the webinar today about women and investing. We talk about investing all the time, but often it's not customized or coming from the perspective of women and how various aspects of women's life can make that different or not exactly the same as what the investing industry tries to do otherwise, because of, for one, the very evident gender pay gap that everybody has documented enough that I don't need to say or talk about. And two, the various life circumstances that women face, which actually only exacerbates the gender gap, because then you're missing out not just on pay if you take time off, but also miss out on contribution from the employer, contribution towards your retirement. So it's kind of like an overall impact that women end up suffering, and they live longer. They are the better human beings, of course, the superior Homo sapiens, and therefore they have to plan for retirement, which they often don't. So today's session is about discussing some of those issues that women face and how we can solve for some of them. I'm excited to welcome two of our stellar panelists. I think we are honored to have both of them. We have with us Karina. Karina is a director at Deutsche Bank, investment banking, and she leads the consumer and retail team there. She has an MBA from Wharton School, and she spent 4 years in the CPG industry before that. Karina is not just a very well-known investment banker on Wall Street, but she's also a big supporter of women in general. So welcome, Karina, to our webinar, and I'm excited to hear what you have to share with everyone.
Thank you, Khushbu. It's an honor to be here and share some of my perspectives on investing as a woman.
Awesome. We also have with us Rita Lee. Rita is a wealth professional with experience in top investment funds in Toronto and Hong Kong. She is a University of Toronto major, and she has an MBA from Richard Ivey School. She is a CFA designation holder, and Rita is a wealth advisor with RBC Dominion Securities right now. And like Karina, again, Rita has been a big champion of women, and not only with RBC, but with us in the past. She has provided free advice to women and offered her time off and on to women who are interested in getting more financial planning advice. So thank you, Rita, for joining us today.
Thank you, Khushbu. Hello, everyone. Thanks for joining us.
Awesome. So why don't I start this first of all for everyone to just understand, how do each of you go about your investment planning? Let me start there. Karina, do you want to start there?
Yeah, I can get started. So not long ago, maybe about 5 years or so after graduating from business school, I really didn't have an investing strategy. I came out of business school, I started working as an investment bank, and I was very familiar with investing, but from the perspective of an employee giving advice to companies that about investments, not personal. But I thought, well, it's important, it's part of life. And that's when I started doing a little bit more homework to start my personal investing. So first of all, you need to understand what your goals and objectives are, and that's where I started. Like, what do I want to accomplish? When do I need the money? What do I need this for? What I'm aiming to do with this? And that's how I got started in investing myself. I took into consideration multiple things. I went on deciding that for me, real estate was going to be one of my first big investments. As you all know, real estate has been one of the sources of wealth historically. So I thought, well, this is a good way to start building my own wealth and building my own investing base. So that's when I wanted to start and thought about moving and buying a house. So that was kind of the first big step in investing. And then obviously investing in some individual stocks or mutual funds or ETFs. was part of the game as well, and part of what I considered. And more recently, because investing is never like one thing in time, you have to continue evolving and making sure that your objectives change with your lifestyle and with your needs. More recently, I started thinking more about venture capital investing. So it has been evolving a lot for me.
That's awesome. And it's interesting that you bring real estate, because one of the things that I would always love to talk about is investing in real estate and how inaccessible it is to regular people. And it seems like women are often not as actively thinking about real estate, whereas we as a platform have a lot of women investors. And one of the reasons is that we make the minimum investment to enter real estate really small. So our minimum investment is $2,500 for fractional investing in a house. So you're basically buying a fraction of a house, but only for first-time women investors, since often they are like held back by indecision. We are providing a promo of $100 as the minimum investment. So anybody who invests in the month of October, they can start investing at $100. So Rita, what is your personal journey on investing? And you are a wealth advisor and investment advisor. So looking forward to hear, how do you manage your own money?
Sounds good. Thanks, Khushbu. So my path are similar to Karina, but also a little bit different. When I was younger, primarily, you don't have a lot of savings at then, and then you pay off student loan and things like that. From a personal career standpoint, I worked, primarily in the investment space. So it's actually what I do. I did equity research, which is literally to analyze companies and stocks. So this is where I focus most of my investment energy in. I should invest more in real estate as well. But for me, the way I think of it is, it's kind of like being in school and study. It's really good to have an objective. So from a family financial planning perspective, I want to know what our goal is, how much saving, how much net investable asset, how much fixed asset, how much, how do we manage debt and liability, at what age, and what are the milestones that we want for the family. And then secondly is really just picking the investment. And there's a whole risk of spectrum that's available for everyone. So, I invest my personal investment portfolio similar to how I manage for all my clients. So I invest the same way as my clients. But yeah, that's how I look at it.
Cool. We'll come to specifics on exactly what percentage you put into what part. But I think one of the questions, and there's a recent Fidelity study that kind of reinforces the fact that women are not investing as much as men, and that gap is reducing, but it's still there. In your perspective, why do women traditionally not invest as much and are not as actively involved in investing as men, and what are the challenges you think they are facing?
Yeah, so a little bit more specific in terms of looking at your investment portfolio, you can think of it in terms of risk. So, which part of the capital do you want to be more growth oriented? So you maybe take on more volatility or more, risk. And which part do you want more capital preservation or income? And you can take a look at, for example, how is the Canada pension plan, how is your CPP being invested, for example, right? There's a percentage to the public equities, there's a percentage to real estate and, alternative space. So that's how I would encourage everyone to look at your portfolio construction. And in terms of women being perhaps a little bit behind in terms of investing, I think I don't believe it's the education gap, because I think women are as educated as men, equally as educated. I think maybe it's a comfort level and the risk appetite potentially. It may be psychological or behavior is what I think. And that, of course, can be changed. And I think there's a trend that's changing that right now.
Yeah, I would think similarly that there is a big gap in the risk appetite for men and women. And one of the reasons might be just the nature of female versus men. But there's also another big impact, which I think is the women usually tend to leave the workforce earlier in their careers than men. That's a fact. It's not how it should be, but that's what it is. So they build wealth just through a short period of time, and then they probably don't feel that they have either enough wealth to start investing because they have this risk to maybe lose what they built, or maybe because they don't have enough, or maybe because they switch their thinking towards preservation rather or use of this wealth rather than investing and creating more wealth. So I think it's also a matter of like how much women can contribute or build over time before she leaves the workforce, and then she becomes more just like a family planner rather than like an active investor. So I think it's also a little bit of lifestyle or like men versus women type of thing. This is obviously a general statement, and there might be women who obviously are still in their careers and they're still building wealth. And in that case, it might go back to just risk aversion, or maybe just knowledge. They are not knowledgeable enough about what does it take to start investing, and they just don't want to give or take the first step. And I think that first step, like getting comfortable with investing, it might be just a matter of most of the training or most of the things out there about investing or support or advisors usually tend to advertise or seek for clients that are male in the male population. So maybe the female are also lacking those sources or those opportunities to start growing their knowledge and becoming a little bit more comfortable investing.
Fair enough. You've, I think, highlighted a bunch of points. One, there's a preservation versus growing mentality, which I think, referring to that Fidelity study again, and they do it, I think, every 2 years or so, 75% were confident balancing a checkbook. They were happy understanding the finances of their household, the budgeting, the managing. So clearly, it's not like they are not numbers people, and it's not like they don't understand financing or the concept of finance and budgeting and saving and all of that stuff. But then 75% being confident with their household finance, only 20% were actually confident selecting investments. Which is funny, because if you understand how money works, how you need to plan for it, you should be thinking about investing as well. So probably there's maybe, I don't know, people are not taking the right steps soon enough. I am partly guilty of that too, to be honest. Like apart from the retirement fund and Amazon stock, which I got by default by the virtue of working there at one point in time, there isn't as much active investing that I have done. And it's only in the last few years that I've actually started changing. Even though I was a big saver, I used to sit on cash all the time, making sure I always have a buffer. I wasn't deploying it to grow. And so I think it's probably taking the first step. So let me actually do a quick check on what the audience think and whether they would want to grow their money and like grow it as a pace as required to at least keep up with inflation and make sure they're not just preserving but growing their wealth. I'll give people another 30 seconds and then we'll see how it goes. Yeah, question. Tim. Hi, Tim. Your question is, when would we expect the reports from the third quarter? I'm sure it's on its way, so it should be fine. But I think you can always email us with if you ever have questions on how your investments are doing. In that context, for people who invest with us, we send out a quarterly report and do rental distributions for the houses they invest in every quarter. So once a quarter, whatever is the net rental distribution based on the investments you've made, you will get a proportion. And of course, you will get a detailed report of what happened that quarter. Cool. It looks like at least the crowd is motivated, but that's always the case because people who are attending webinars are clearly actively trying to do things. The next question is, what are the benefits of investing for women, and what do you think are the common financial mistakes that women make? And Karina, maybe I start with you. You seem to have done a lot of thinking and planning on this front.
I think thinking and planning is actually probably one of the main mistakes that women do. I would say you need to start early and you need to plan. You need to know what you're headed to. Like, what do you want to achieve with the things that you're investing? So that's probably most important when you start investing. In investing is not contradictory to building wealth for your family or taking care of your budget in the household. You obviously have to think about what your needs are, but if you have kids or thinking about having kids, then maybe you think or you direct your investing strategy towards building some wealth that will help pay for the college for your kids. So they're never contradictory. You need to find ways, and that's all part of the planning and the thinking. Like, what exactly do you need, and when do you plan to use these resources? Maybe it's a long-term investing, or maybe it's short-term, and you're just looking to get some gains in the next 12 months or 24 months because you have a specific project in mind. So thinking and planning is probably one of the most important things, and probably one of the largest mistakes that people do at investing, because they don't think ahead and they just go ahead without actually having a strategy in mind. And then in terms of benefits, well, I think as everything in investing, you need to be somewhat diversified and you need to have a balanced portfolio. If, as a woman, you have a different perspective. So if you are investing on behalf of your household, then you bring a different perspective and you probably can find a more balanced portfolio for your household because that's a different view than just having one person do all the investing at home. So that's a big benefit for a household. And just personally, I think it's also rewarding to know that you have control over your finances and that you actually can do a lot of different projects and invest in something that it's interesting for you or invest in something that you care about. And right now, there are a lot of new things coming up for investing, such as cryptocurrencies. So if you have an interest in that, that might be a good place to start because you will learn from that. Or there's also a lot more green bonds and sustainability type of investments. So if that's of interest, that could be a good way to start as well, because it piques your interest and then you learn more and more about it and you become more sophisticated.
Cool. Rita, what do you think?
Yeah, I agree with Karina. I think that planning is so important. So especially, as a family, I was talking to, my mom's group, and we were just saying that we're kind of like the CFO and CEO of the family. And it just kind of really makes sense to oversee investment as well. I'm of the view that I think that as a family unit, it's great to work with a husband, to kind of have a plan for the family that you work towards together, right? I think everyone has their own kind of, one person tend to be better at something, and that's normal. For example, when we first started dating, we started playing video games together, which, by the way, is a great team building activity. And he was completely okay for me to kind of ramp up to his level. And in return, I'm more than happy to talk about, investment and how interest rates and inflation, things like that, impact our investment portfolio, right? But I do observe there is a difference between, say, I'm sitting together with a couple, a family. You know, the men are more focused on just the rate of return for the portfolio, and the women definitely, it's, you know, what does this mean for us in terms of as a family? Are we meeting our goals? You know, are we meeting the education fund for our kids and things like that, which is, you know, so important too, right? One of the common mistakes, I guess, is not perhaps starting as early or early enough, but I kind of see that as, you know, when you're younger, there's not that much to invest, but maybe towards when there's more surplus cash, that's when you really start kind of planning and understand investment more, and also understand taxes more, because that's so important. It takes a huge chunk out of your income and investment returns. So I would encourage everyone to file their own tax returns if possible. And that really helps you to understand, you know, your cash flow and budgeting and things like that. Another part is maybe psychological, you know, to understand the relationship between your attitude and your relationship with money. I think is something that people don't necessarily talk about, but it's worth taking a look at. You know, delayed gratification is so important when it comes to saving and investing too, right? So softer things like that.
Got it. And Rita and Karina, like, are there resources, and maybe Rita, I can start with you, are there resources that women can easily access? So I know we at Buy Properly do a lot of master classes. We are doing a few later this month. That is just purely education, usually held by finance professors. So it's not random stuff. It's not salesy. It's just pure play facts. And so we are doing a bunch of education, but outside in general, you talked about taxes, you talked about just being, doing more. What can people access that is available freely, cheaply, or maybe just free, that women can access and build their confidence?
Yeah,
confidence, but it's good to have references.
Yeah, for sure. I think we're living this age where, you know, for anything really, medical, legal, finances, you just Google and then you can get some instant answers. But it may not necessarily be good quality answers for you. Generally, you know, great advice doesn't come freely necessarily, but you know, a lot of times there are webinars like yours. I know you're putting on master classes. I'm very happy to participate, and but there are definitely resources that you can turn to for that as well. And if you have any questions about, you know, just reach out to me, and I'll be happy to answer your questions too.
Yeah, so people can always book time with Rita. Sorry, Karina. People can always book time with Rita for a one-on-one free financial planning advice.
I might take up on that.
Yeah, I have already booked time with Rita on that one.
Need of advice, even if you're done investing before. But I think resources depend on where you are in your investment knowledge and sophistication. One thing that I find very helpful, at least, is to have or be part of a newsletter that gets to my email every morning and gives you a quick glance of what's going on in the markets, what's going on in the economy, because it gives you just a sense of what's going on, like where is the safest place that I feel comfortable in investing my money. And those newsletters, there are a bunch of them that are free. You can just subscribe and then you get it. And they give you every morning just like a quick glance of the markets and by industry, or like some stocks that you care about or stuff like that. And then one that I found very helpful is one. It's called, probably, and I'm not meaning to advertise anything. I'm not getting paid here. It's called Skim. They have one-on-one financing resources online. It's similar to what you do, Kushbu. It's just something that is purely educational. You get on their website, you watch a video, and they teach you the basics of it. So if you are at that level where you're just taking the first step, it's a one-on-one for investing. It gives you kind of the general knowledge that you will need to start. If you're a little bit more sophisticated and you are thinking about just building a more robust portfolio or changing the risk profile, probably an advisor would be your best source, someone who has some experience that can share more specific advice targeted to your needs. And I think just overall, wherever you are in that sophistication spectrum, bouncing off ideas with someone is helpful as well. Just someone that you trust. It might be just your significant other. It might be like a friend. Just bounce off some ideas and say like, I really have this extra cash. I would like to invest. My risk appetite is actually very, very aggressive right now. I feel that I want to do something different. I watch these 2 stocks that are new. What do you think? Just bounce off ideas. I think you will get some feedback, and then that can also be helpful.
Got it. Yeah, adding to that resource list, there's one that I follow that's specifically geared towards women. It's called Ellevest, Ellevest. It's a company based out of New York, and their entire business model is geared towards women and women investing. So it might be a good resource. There's another one. It's more of a startup, so not as big and not as many courses, but it's based out of Amsterdam, and it's called Female Invest. Again, another resource that's specifically directed towards women and would talk about all of the things related to investing. Like personally, I think I am one of those risk-averse people. I know I looks like I'm not because I'm a startup founder, but I am pretty risk averse. And one thing that I have done in the past to overcome my own fears is create a shadow portfolio. So every time I want to try something new, I create like this small portfolio, so the composition, but on a smaller scale. Sometimes they do very well. Actually, often they do very well, and I regret why it was a small portfolio. So there was one that I put together about 2 years ago with a lot of new stocks or new information, did a bunch of research and put together a small portfolio. The portfolio is up like 300% after 2 years, which kind of builds my confidence to say, okay, I didn't do it incorrectly, except I didn't put much money. So my husband was like, why didn't you put like a large amount towards it? It's up 300% in 2 years. But what it does is helps me try small, experiment with a lot of new things. With no risk. Like if I put in like 5, 10, 20K and or whatever the amount is that somebody is comfortable losing, I just assume it's my entertainment money. And then when I'm sure that I'm thinking the right way about it, then I can scale it up and do it on a larger scale. I know it's a slower process, but definitely builds confidence.
Yeah. Just to add to that, for people that live in Canada, for example, I'm just doing a plug-in because I am with RBC too. The local banks is actually a pretty good source in terms of getting the financial information. If you are Canadian, definitely take advantage of the tax-deferred vehicles like TFSA, RSP. It's a no-brainer to do that because you just want to leverage that and reduce your overall tax burden, right? And in terms of picking stocks, I think if you just want to start, where do you get your favorite morning cup of coffee? And if you read in the news that their profitability is going up, there's some positive changes going on with the company, that may be a good way to start to kind of look at what takes away from your everyday bill. And maybe you want to invest in some of these companies, right? If you purchase a lot of Apple product, it's not a recommendation, by the way, but just to say that, you can think of it as a reimbursement to your expenses. But that could be a really good way to look at it. There are tons of vehicles available, ETFs, mutual funds. They're really just, the way it's a portfolio of some of these underlying stocks that we're talking about too. So definitely there are a couple, really good ways to start. And I think there are actually quite a lot of resources available if you're interested in that.
In terms of investing, and again, we've talked about it generically and thinking overall, like in terms of specifics, what are the places women should start putting money in? And do you guys have a recommended percentage of investable assets that they should be putting in towards stocks, bonds, real estate, and I call it entertainment, but basically things like anything that's new. It could be cryptocurrency a few years ago, now it's no longer new. It could be NFTs right now, but are there recommendations on how you allocate that percentage and where do you start basically, if you haven't done anything outside of the automatic employer deduction, which by the way, I think everybody should maximize, but after that, do what?
I think it goes back to your risk appetite. And I think one of the first things that you need to do, we spoke about it, is thinking and planning. So a good place to start is define a percentage that you want to allocate to more risky assets. That could be anything new. Define a percentage that you want to allocate to something that you feel is a bit more safe and secure for you. It could be an ETF because it captures like multiple things in there. It could be just an index. An index can also work like S&P 500. So you allocate percentages, and that's a good step because already you know from the total amount of money that you're going to invest, like how much should go to each of the different types of investments. And then take a look at each of the pieces of the pie and start thinking about what is going to be the composition of the new investing or new equities. What's the composition of that, like more safe or mature? And maybe you have one that it's more that you're looking to get more like consistent returns, and you start thinking about what's the composition of that piece of the pie. That should probably be more things like such bonds or things that give you back money on like a more short time period and frequent period. So it depends on that like pie that you set up at the beginning.
Are there thumb rules that you would recommend? Like I know from real estate perspective, we often recommend that people at least put somewhere between depending on the age they are, somewhere between like 20 to 40% should be towards real estate, just because it's such a stable anchor and not as volatile as say stocks, and definitely better returns than bonds. But outside of that, are there thumb rules that people should follow or you follow personally that you would recommend, Karina?
I think that depends on your age. Like, the younger you are, the more you can allocate towards risky things. As you become a little bit more old and you're looking for more like secure investments, then probably you switch that percentage. For me, it's 60-40. That's my rule of thumb, and that works for me.
So 60% equity?
Yes, and 40% something that is more like fixed equities or fixed securities. And then from the 60% equities, I have a very small piece that I think about it as like new investment, which is the cryptocurrency fund or the BC fund, which is something more new to me. Like I'm starting to think about allocating a piece towards venture capital. That's probably not accessible to everyone. Venture capital tends to be a little bit more infrequent or rare because you just don't go to an advisor or like a broker and then you just put your money in that. You need to have some sort of network connection to be able to invest into a PC company. But that's my rule of thumb, 60-40, and then I split that 60 and that 40 in smaller pieces.
Got it. Awesome. Rita, what are your thoughts on that?
Yeah, I think just in terms of specifics, it's a little bit difficult to generalize because everyone has a different, some of the key consideration is what's your time horizon? What's your overall net worth? What's your liquidity needs? Do you need an income generated from portfolio, for example? So things like that all really play into a factor. So it's a little bit difficult to say that this is kind of like the golden rule ratio that you should have. But like Karina said, your age and time horizon and a couple of other key factors are important. I go back to the pension scenario where you can take a look at the CPP allocation for your Canada pension plan. How are they allocated? But at the same time, it's not necessarily accessible to individual investors. They have billions and trillions, and they have access to investment opportunities that we don't. So, so that's one. Sorry, what was the main question?
Just trying to get tips from you on like thumb rules of investing, on how you would go about, and what outside of retirement should people put their money towards, basically.
Yeah, so for 60-40, that has become a little bit more challenging in recent years as well, just because interest rates so low, and it's not really, there's not much lower bound they can go. So, it's difficult to turn up too much return from the bond side. So there are some, relative considerations bands that you can play with. All else fails, do talk to someone like an investment professional like myself, because personally, I wouldn't try to draft my own will, for example, right? So, so from an investment advisor's perspective, it's not really, I don't think it's our role to consistently beat the market for you, but it is our role to communicate your risk rewards and what to expect from investments. From my view, is that the financial market generally are priced accordingly. There's not often very much mispricing going on. So if you want higher risk, higher return, you do need to take on higher volatility. And that's a conversation to have to kind of determine if that's what you want.
Yeah, another rule of thumb, if I may, and I think this is helpful for me and might be helpful for other people as well, is if you're thinking about a risky investment, allocate certain amount of money to invest in that particular thing. So my example is cryptocurrency. So this is my pool of money, and it's not in terms of percentage of my whole wealth. It's just a specific amount, dollar amount. This is the amount of money that I'm willing to put into cryptocurrencies. I invested in it, and then I made myself to reassess returns every year or so, because it's so volatile that I wanted to make sure I was taking some returns out of the initial investment. So every year I kind of go back, see how much I've got from that investment. And if there's particular returns or good returns, I will take those returns and just keep the base amount of money in there, the initial amount, and it will continue, hopefully, to increase and bring more returns. But I take out some of the returns and then reallocate it to all other more secure piece of my portfolio. But that's just me, and it helps me because I know it's so volatile that I'm not so comfortable with volatility, that I decided that strategy or that rule of thumb, like this is my amount in dollars that I'm willing to put in, works for me.
Got it. One question, and it's like probably a more women-centric question. When you're thinking about investing or financial planning in general, how do you plan? So there's a lot of advice on how do you plan for retirement, towards goals. How do you plan for a career break? And should you be planning for it? Like, I guess you should, is the default answer. But like, how do you plan for a career break, whether it's a maternity leave, which in Canada, by the way, Karina, you're in the US, is about a year. Like a lot of women take a year or a year and a half off, which is a reasonably long time. And how does one plan about it? What does one do to make sure it doesn't impact their long-term financial well-being? Either of you, who wants to go first?
Okay. Yeah, so I think, maternity leave is such a personal question. Personally, I chose to take a shorter maternity leave, while my best friend took a longer one, and she had 2 babies. I think from a financial planning perspective, it's about the trade-off, right? So, I would say before you plan a break, you just really kind of look at the finances and make sure you're okay with that. What does that mean? How does that impact your short-term goals versus long-term goals? And whatever your decision is in the end, that would be the right one for you. But at least you know how that impacts you financially overall, right? So if you take a bit of a break, maybe a more delayed retirement or potentially. But those are the things that you can plug into a financial plan, and then you can kind of look at the numbers. And I'm sort of a numbers person. Okay, so those things that really help you to make an informed decision.
Yeah, in my personal situation, I really didn't have to do anything different from a planning perspective or from an investing perspective to be able to take my maternity leave when I had my babies. The US is much shorter; it's just 16 weeks. What I got, and I was getting 100% of my pay during those times, so I didn't really have to plan anything different during that time. But I think it goes back to thinking and planning. So just take the first step ahead of your maternity leave or ahead of that specific life event that it's coming, so you are prepared for it.
Got it. Karina, this time maybe I'll start with you because you touched upon this earlier. But how do you think, or how does one plan to ensure that you are investing in line with your values? So you talked about sustainability earlier. So now you do have ESG funds and ESG bonds that are out there. But outside of that, are there other things that people can look at to make sure that you are investing in line with your values, and you're not putting in money towards companies that you don't believe in, companies that you believe God knows does what, where in a remote continent kind of thing, is flouting like basic human values, things like that. Where do you do this research? What do you go about? How do you go about this whole thing?
Yes, individual investing, it's a bit harder to do because you're not going to go do a full diligence on the stock that you're going to be investing. But you can start by just laying down in a list the type of industries that you're not comfortable investing. So it could be anything, but if you have something against tobacco companies, just put it in the list. If you would not be happy to invest in companies that have animal testing, just put it in the list. So just lay out that list of things that you care about and you don't want, like the real no-nos that you are not going to be allowing your investments to have, and then go back to searching some stocks that you like and make sure you go back to your list and you check each of these items just to make sure that you're not falling in any of these big categories. And I think that this list should not be a laundry list. It should be big themes that you really, really care about, because if you go too long of a laundry list, then it will be a bit harder for you, and rather than helping you, it might actually create more stress and create more limitations towards what you are comfortable investing in.
Thank you. Rita.
Yeah, so I want to start on the positive. I think that right now it's more possible to invest aligned with your beliefs and your values more than ever in my entire investment career. But then that said, it's still a developing standards. When you even just Google search a stock, you can see a ESG type of rating. And that kind of reporting standard is still being formed because it is a complex piece, right? And that would take time for it to kind of formalize and for you to kind of really be able to rely on it. Personally, I really care about the environment. I think, some of the things that we take for granted, like clean air, water, nice weather, those are the things that, a little bit selfishly, I want to make sure that my children can enjoy as well. And that's just kind of so important. I think companies themselves, historically, damage to the environment, that cost is not counted for, right? Because it's shared by everyone and it's not accounted as a part of their expenses, things like that. Things like on the human capital side, mental health, work-life balance, general happiness, those sort of things are not really considered either. But I think that's kind of changing. And you know, we are going towards a trend where companies are not just judged, their performance is not just on the profitability, but also their corporate citizenship. And I think that's really important. And I'm just super excited to see how this develops.
Awesome. Mindful of time, just wanted to see if you guys have any tips. Like if you were to say top 3 things that you should start doing today, what is it that it would be that you would say to the women investors out there?
Okay, I would say work as a family. I would say set short-term and long-term goals. And lastly, just develop a general interest, you know, something that you find that's meaningful to you that you want to follow, and then find the investment aspect of it and act on it.
Awesome, thank you.
And I think I would say start early. This is just personal story, but I was born and raised in Mexico, and in Mexico there's no culture of investing. My parents have by any means any sophistication in investing, and that's not something that it's brought up often when you're a kid. So I really didn't know anything about it until I was a grown up and I started working in finance, that I actually started learning more about it and becoming a little bit more interested in investing. So I really started late. I think that when I look at my kids, I would like them to start early. So that would be my recommendation number 1. Start early, get knowledgeable about it. The more you do it, probably the more comfortable you're going to be, and you're going to feel a bit more rewarded by the means of investing.
Thank you. That's very meaningful, Karina. And if you ask me, the way I have always been hindered, in spite of being a saver, is like trying to make a big move and not taking that first step. So I personally feel that probably the first thing to do is do something rather than getting into this analysis paralysis conundrum that we are often tempted to be in. And that's one of the reasons why we thought that, especially for first-time women investors trying out a new product like fractional real estate investing, we maybe need to give them a little bit of push and say, invest $100 and see how the whole thing works and learn. So sometimes it's just about starting small, but doing something and then learn from it and build on it over time, rather than just plan for doing it the perfect way. But thank you both. Really appreciate your time. And super exciting to learn how both of you are investing personally as well, learning from that. And thank you for sharing all the resources. Thank you, everyone.
Thank you so much, Kushbu. Always a pleasure. Thanks, everyone. Thank you,
Thanks,
Karina.
everyone. Bye.